Most people fail to consistently beat the stock market. In this video, I'm going to tell you why, and I'm going to give you some tactics to overcome these problems. Plus, I'll do my normal market analysis, and then we'll look at the trade of the week, a stock that doubled over the course of the week, and the trade signals that came along the way. All right, well, let's talk about this notion that most people really don't beat the stock market consistently. They may do well for a little while and then often give back those gains later. So why is this? Well, it really comes down to the fact that most people have an emotional attachment to money, and that causes them to make bad decisions when their money is on the line. You know, of course, you always need to have a good strategy. You need to have good indicators or good tools, that sort of thing. And those things are easily found, and really you can gain that knowledge relatively simply. The issue comes down to actually following the rules. And again, the reason why is we have an emotional attachment to money. So what we have to do is stop being a normal person, because normal people will make decisions based on fear or greed. Now, fear is the more powerful one. And there's two types of fear. The fear of losing. People don't like to take losses, and so they tend to let small losses grow into big losses. And then the second type of fear is the fear of missing out. And that means we chase stocks higher and don't have discipline in where we buy the position. And I'm going to show you an example at the end of the video where I walk you through these kinds of problems and how you combat them. To overcome these issues, we must do two things. We must understand our tolerance for risk, which is how much are you willing to lose? Now, why is that important? Because if you're taking on too much risk, then you're going to make those emotional decisions because you're not comfortable with the potential for loss. And so what typically happens when you take on too much risk is when the trade doesn't work, and there's always going to be some trades that don't work. When a trade doesn't work, you don't sell it. In other words, let's say you bought a stock at $10 and your stop loss point is at $9, and the stock falls to $9 and you're looking at a $1,000 loss because you bought 1,000 shares. Well, if you're not comfortable with that $1,000 loss, you're probably not going to sell it at $9, even though your rules from your well-tested strategy tell you that that's the point that the market has proven you wrong, you need to get out. And so instead what happens is we hang on, and it goes down to 7, and it goes down to 6, and down to 5, and it just keeps going down. And the result then is a small loss, a manageable loss, turns into a big loss that outweighs many different profits. Now, if you had been comfortable with the $1,000 loss, then you would just say, it didn't work, and you get out. But if you're not comfortable with that $1,000 risk tolerance, what that really means is you bought too many shares. And that's where the problem starts, is you bought too much. And so if you're only comfortable with a $100 loss because your portfolio is, say, $5,000, then that's how many shares you should buy. Not 1,000 shares, but instead 100 shares. Now, the second way to overcome these issues is to have a written plan. And a written plan should have these components. Rules for entry, and they should be very specific. There should be no room for emotion. I always tell my students, you need to make it in a series of bullets or checklists that a computer could follow. Don't say, I'll buy stocks that are breaking out. Well, that's too general. Be specific. So, for example, one of my strategies might look like, buy a stock that's breaking through resistance from low price volatility, that has abnormal activity, that has strong liquidity, that has rising bottoms into the breakout, that has at least 2-to-1 reward for risk up to the next level of resistance. Those are very specific checklist points that you have in your plan. Now, the reason you have to write this down is because in the heat of the moment, when you're actually making the trades, there's a very good chance that your emotion will override your rational decision making. We have two parts of our brain that tend to affect our trading decisions. There's the prefrontal cortex, which is where we actually think. And in the evening, when the market's closed, we make great decisions because that's the part of our brain that's working. Now, in the trading day, when emotion is higher, when you're worried about losing, or when you're worried about missing out on an opportunity, now that prefrontal cortex part of our brain turns off, and what is favored instead is the amygdala, the little almond-sized part of your brain that is responsible for protecting you from danger. fight or flight brain. And that brain does not think very well for a trader. It will cause you to chase stocks higher. It will cause you to not take a loss because that's pain. You're pursuing pleasure and you're avoiding pain because the wrong part of your brain is being used. So if instead you have a checklist, well, now you have something mechanical that you can go through and make sure, okay, do I have this? Do I have this? Do I have this? Yeah, it'll slow down your process a little bit, but when you're learning, it's so essential to slow it down and identify whether the trade actually fits your rules. Now, this next part that we want to talk about is the rules for risk management. So how much are you willing to lose? If you have $1 million portfolio, you have more potential to lose, but that doesn't mean that you have more emotional capacity for a loss. You have to think, what does a loss amount, how does it affect me? What is the loss that hurts me? And so if you have $1 million portfolio, but it bothers you to lose $1,000, then you have to scale back your risk tolerance. If you take too much risk, you're going to make emotional mistakes. So very important, understand your risk tolerance. Now, I always tell my students, start with a risk tolerance of 0. By that I mean only paper trade to begin with, because you have to learn, you have to develop your process, you have to develop your confidence in your strategy. And you can do that with $1,000 of risk per trade or $0 of risk per trade. The practice is the same, but I guarantee you when you're starting out, you're going to make mistakes. So why have those mistakes cost you more than necessary? Now, some people say, yeah, but when you paper trade, there's no emotion. Yeah, that's the point. You're just trying to get good at trading first, and then start with a small amount of risk, $50 a trade of risk. Have some success at that level. Make $500. Then jump your risk tolerance up to $100 of risk. Okay, practice at that level. Make $1,000. Now increase your risk to $200. Make $2,000. Slowly ladder up your risk tolerance so that you desensitize yourself to the emotional attachment that you have to the money. Rules for exit. Be specific. No room for emotion. When am I going to sell? What method am I using? I teach a very mechanical method for when to sell using something called reward for risk lines. There's no real room for emotion. You just apply some logic. It's not complicated, but it takes out the emotion. And then finally, in your plan, you should have a step-by-step process for identifying opportunities. It's not enough to know, I will buy when this happens. How are you going to find the right stocks? How are you going to put those correct stocks in front of you? What are your tools? What are your steps to identify those opportunities? That should also be in your plan. I always like to also include a visual reference because, again, in the heat of the trading day, you might lose your mind a little bit. And if you've got that visual reference that says, this is what I'm looking for, this is the pattern I'm looking for, then you're going to be that much more effective at applying your strategy. All right, well, let's get into this week's analysis of the markets. I'm going to jump back to the Stockscores website. And before I get into the analysis, just a reminder, I have a free weekly newsletter where I teach some of these trading tactics. You can register for that at stockscores.com right here. Start your free Stockscores membership and get the weekly email newsletter. I encourage everyone to do that. But let's get right into the analysis, and we're going to start with the S&P 500, which had a big breakdown on Thursday. And in doing so, it broke this pattern of rising bottoms and did so from a little falling top. This is a negative, and it points to the potential for more weakness. Now, why did this happen? I think there's a very likely chance that investors are just nervous going into the election. And so a lot of people just want to take money off the table and get out of the market before the election happens. Now, that is a fear-based approach to the market. There's no real sense of why one candidate would be bad for the stock market over another, but there is a fear that there could be, violence around election day or some other crazy things happening. And so a lot of people just say, I don't want to be part of that. Now, we can see another reason for that probably being the case when you look at the VIX, and this is one of the ETFs that is based on the volatility, the implied volatility of the S&P 500 futures. And it took a big spike higher on Thursday. So this is people buying protection going into the election. Now, if history is a guide, there probably won't be a lot of downward move or upward move right away. If you think back to 2016 when Trump won the election, in the after hours, when it was announced that he won, the market went down sharply. And then it reversed and it went up sharply, all in the course of 24 hours. So we could see that kind of volatility, although I don't think so. I think that was a unique case for 2016. Most likely we'll get a little bit of volatility around the election. People will then start to go back to business, which is buying good stocks. And we've had kind of a slow market the last week and a half, 2 weeks, because I think a lot of people just sitting on their hands, they don't want to take positions ahead of the election. All right, let's jump into the NASDAQ now. QQQ is the symbol for the NASDAQ 100 ETF. And you can see there, again, that cycle of rising bottoms broken. If we dive into the intraday chart, it's essentially a neutral chart. We've gone sideways. We have that little breakdown here. If we go 3-year, we can see that the upward trend on the 3-year is still intact. We've essentially seen the NASDAQ hit resistance, get stuck. It's very normal for this to happen. When you rally into resistance, you get stuck at resistance. And so we're probably going to pull back a little bit. But because the trend is still up, the momentum is still there, looking out weeks, I think we're going to be fine. But the next few days could see some volatility to the downside. Let's take a look at the Russell 2000 Small Cap Index, IWM. And there you can see, again, a little weakness on Thursday. It's still in a relatively optimistic pattern. The buyers are in control. We are just tickling that upward trend line. We have resistance here. And so the market needs to hold this trend line, hold this low for sure. And then if it can do so, rally back. I think we'll get a breakout in the IWM when we see the bond market stabilize. I'll talk about the bond market in just a minute. First, let's go to the Canadian market. T.XIU is the symbol for the TSX. A little bit of profit taking. It's been a very strong market. Really, the stronger of the Canadian and American markets has been the TSX. And it has just had a couple weeks of profit taking. That's reasonable. The trend is still up, and you can see that on the 3-year chart. I think we still could see more profit taking because the market went parabolic here. So anytime a trend goes from linear to getting steeper and steeper, it really is becoming an emotional market where emotional traders are chasing the market higher. And at the end of the video, I'll show you a stock that was really hot this past week and how chasing emotion, that FOMO trade that I talked about at the top of the video, can really cause you problems. I'll show you that in just a minute. All right, let's move along to the gold chart, which is one of the reasons why the Toronto Stock Exchange has done well, because gold has been doing well and mining in general has been improving. It's still in an upward trend. A couple days of profit taking here, Thursday and Friday, but the trend is still up. I just would not want to chase this higher because the trend is going parabolic. And when parabolic trends happen, eventually the bubble bursts and you eventually get a fairly sharp pullback. Haven't really seen the strong signal for that yet, but I would watch for it. All right, let's take a look at oil, USO. Oil, lots of choppy trading. It really lacks direction. You can see that probably the general trend is slightly down, but with so much volatility, it really demonstrates that the market's very uncertain about oil. I just don't think that oil is the right place to be trading right now because it's a market that's stuck. It's been stuck for a year and a half in this, well, really almost 3 years if you think about how this has been. You had this downward trend here, little rally in the middle of 2023, and then it's really been choppy and sideways. So to me, it's not a market that looks awesome for trading right now, and I would generally avoid the oil market. All right, let's take a look at currencies. UUP is the US dollar. It's had this really strong rally as investors think that there won't be as many interest rate cuts. And so money is flowing into the US dollar and flowing out of a lot of the other currencies around the world. How about Bitcoin? I know a lot of you follow crypto. It has done well the last 2 months, but in the big picture, if we go to this 3-year chart, it's still kind of stuck in this choppy downward trend. And it's getting up near the top of that downward trend on GBTC anyway. And so I think we could see, a little pullback here in the short term. I don't like a market that's choppy like this. I prefer markets that are breaking up from rising bottoms like it did here. It did it a number of times. Those were the buy signals. And then the market went parabolic and it had a bursting bubble here. I call that a bursting bubble candle when you hit a new high but close red, close down for the week. And since that time, Bitcoin's really been kind of dead money unless you're a very short-term trader and you take advantage of that short-term volatility. Now, the last chart we're going to look at is TLT, which I think is a real important one because it will drive performance in the broader market. And you can see that the bond market has been selling off for the last 6 weeks. And that has meant interest rates have been rising in the US for the last 6 weeks. Now it is at a point where it should bounce. If we go to the 3-year weekly chart, you can see we're approaching this our support zone right in here. And so it should bounce back soon, and maybe the election will be the catalyst for that. Economic numbers, if they start to weaken a bit, that'll make investors think that the Fed will do more interest rate drops, and that will be supportive for stocks, especially those small cap stocks, which have been slowly building optimism, but really lagging the large caps, and again, because of their sensitivity to the bond market. So my ratings then, US large caps neutral in the short term and bullish long term. That's a downgrade this week. NASDAQ neutral on both time frames. US small cap the same. Canadian stocks and gold neutral short term and bullish long term. We are starting to see that profit taking in those markets. Oil remains bearish short term and neutral long term. US dollar and Bitcoin short term bullish but neutral long term, and bonds bearish in the short term, but because it's near that support zone, I'm going to give it a neutral rating in the longer term. All right, let's go to the trade of the week. This is an example of a stock from the past week that did well and fit my rules. I talked about the importance of having rules at the top of the lesson this week. And if you want to learn more about my rules, go to stockscores.com and you can learn more about the training that we do there. All right, let's jump into this stock. And this week I'm actually showing a swing trade. The day trading action this week was not great. Again, I think a lot of traders sitting on the sidelines. And if you've been watching my videos, you'll know that I love my action candle indicator. It's these pink dots, so everywhere you see these little pink and yellow dots here, those are all action candles. But not every action candle matters. We want the action candles that either break a pullback or break from low volatility. And this goes back to the idea that one of the problems that traders have is FOMO. The fear of missing out causes people to chase the market higher. And so we don't want to be part of that crowd. We want to sell to those people. We want to buy when the stock starts to move, and then let the FOMO traders chase it, move it up, chase it higher, and we're going to sell to them. So if you look at this chart here, you can see that there is an initial break from low volatility last Friday. That was when the stock was around $5.50, and it moved up nicely from that. I like to buy either the breaks from low volatility or the pullback. So here's a pullback, and there's a break of the pullback. And then you can see the stock rips higher. These are the FOMO traders. These are the people that are stuck in the short sell situation, and they're getting blown out. You can see the volume is strongest because that's when most people, the emotional traders, are chasing the stock up. Do not be a buyer when the trend goes parabolic. Wait for the pullback and then buy the break of the pullback. Or wait for the pullback, buy the break of the pullback. And then the next leg up. Do not be a chaser up here, especially as the stock comes into resistance. Terrible time to be a buyer, and yet that's when volume is strongest because most people are chasing it up there. And so that's just a simple way to approach the market. Start with abnormal activity, inspect the chart to see if the abnormal activity is either breaking a pullback or breaking from low volatility. And by low volatility, I mean essentially sideways, boring trading. And then if that happens, that's your buy point, and then sell when the trend starts to go parabolic, and then wait for the next pullback. I hope you've enjoyed this week's video. If so, click on the like button. I'm going to try to do a new video concept in the next week or two where I answer your questions. And so if you have some questions about trading, maybe some stocks, things like that, put your questions in the comments, and we'll pull a few of those out and then do a video where I do sort of a answer your questions type of video. I think it's a great way to discuss the questions that you have, because so much of what I do is visual. For me to type an answer in the comments doesn't really work, but if I can show you, that's going to work that much better. So if you have some general trading questions or anything about the market, I guess, just throw those in the comments, and again, we'll pick a few out and do a video about that soon. Hope you've enjoyed this week's video. Click the like button, subscribe to the channel. Most importantly, trade well.